you can start preparing for a kid long before you have a kid.
I love that. The easiest one is the 529.
It's going to go to probate.
Okay, good job, Chase. Confounding.
No one's ever told me about that.
Compounding. Like,
let's talk about it.
We still haven't gotten his birth certificate, and I was supposed to get that notarized today.
What am I not getting?
Trouble on my mind. That's the attitude that got my ass off the sidelines. You either ride pine and cry about playing time.
Make sure to like, comment, and subscribe below. Thanks. Welcome back to Chasing Finance. We are here today. Mr. Ben Dunbar, managing partner at Gerber, Kawasaki, and recent father. So how old is your new son?
Banks is 11 weeks old today.
11 weeks old. And so did you start preparing for the child 11 weeks ago?
Just a little bit before that. It's actually about 11 years ago.
11 years ago. And how long have you been at GK?
11 years.
Wow. So let's think about that. 11 years. So where was I 11 years ago?
What were you doing 11 years ago?
I was 14. I was just starting high school.
Probably didn't have your permit yet.
No. So I was probably, I was a freshman in high school, taking Spanish. Oh, I was getting really into photography.
¿Puedes hablar español o no?
¿Por qué? Pequeño.
Okay.
I was actually, this is something I'm really still embarrassed about today. Like my first semester of high school, I took like Spanish 1 because I took Latin in middle school.
Mm-hmm.
So I took Spanish 1 and I like remember it was like hola, ¿cómo estás? Like level. And like I literally got like a B in it. Like I literally couldn't even figure out how to focus on those types of things.
That's why you're doing podcasts.
True.
Different skill set.
I know, and that's where I'm at with my whole studying thing. Like, it's hard to make excuses of why I'm so bad at studying, but it's like I relied on my charm and goodwill to get me through school for so long, and then I got prescribed on ADHD medicine, became a genius for about 5 years, valedictorian qualifier, high school and college, and then was like, this is not good for me. So then I got off of it, and now it's really hard to focus and learn things.
Fair enough.
But I'll do it. Not giving up. So I'm here with recent father, Mr. Ben Dunbar. Remind us again, what is your son's name?
Banks Richard Dunbar.
And how'd you come up with that?
It's funny. I think everyone assumes it's like this finance thing that I actually came up with the name, and like, no, like Katie's the boss. She's
wow.
Yeah, she's the one who came up with the name. Banks. It's funny, like we kind of heard the name from actually a professional surfer.
Okay.
Yeah, she named her son Banks, and then we kind of liked it, and we just tried it on for a while. And then Katie's favorite movie growing up was Father of the Bride.
Agent Cody Banks.
So, yeah, not that.
You don't know that one?
Don't know that one.
Okay,
that might be.
Father of the Bride's a classic, though.
That is a classic. I'm surprised you've seen it.
Hey, oh yeah. Do you know that the church that I've actually attended multiple times, right down the street? Vintage Church was where it was shot.
Oh, I did not know that. Wow,
yeah.
There you go.
Only church I've been to in LA.
Nice.
And they actually do this thing on Wednesday nights where they have an open bar. I swear to God.
Nice.
So it's a good time.
Fair enough. Nice.
Yeah. So, okay. You're going to give your wife credit, but I feel like she did name your son Banks because she supports your career a little bit. She loves the way that you love money. Is there,
Yeah, like, believe me, she supports my career. That's for sure. That's an understatement having to put up with me. But no, it sat right, it fit right.
Okay.
And sometimes when you know, you know.
All right. Well, I think it's a favorite around here. And cool. Let's get into it. Your recent father, 11 weeks in. How are you feeling? Are you tired? Are you lively?
It's pretty funny. I think Banks knew we had this today. At 11 weeks old, he gave us 10 hours of sleep last night.
Really?
And that is not something I share with my other friends who have parents. That's what you'll learn, Chase, when the day comes.
Yeah.
Every kid has a different deal. Every kid's on a different program.
Okay.
And some things are easy for some kids. Some things are hard for other kids. And Banks is a good sleeper. So
okay.
mom and dad are happy about that one.
I still can't make it through a full night.
Yeah, see, that's tough.
Yeah.
That's tough. So, I don't know.
All right. Well, what all right.
Are you stumped?
Just in
forgot
shock.
to do this.
Just in shock.
I thought he was going to be complaining about how hard it is. You know, he's actually really got a positive attitude.
I'm kind of curious about the naming of the baby. What a big decision, obviously, to create the name for a human that's going to have that name their whole life. You said you were trying out the name. What does that look like? You like just call the baby before it's born that name for a while, and you're like, oh, that sticks.
It's funny. Yeah, we called him. It was driving some people crazy. So in our family, this is a little weird back thing, but we call each other Norman, like Norm for short, and it's not a real name. It's not a name in the family or anything like that, but it's something that we do. So like we kept the name to ourselves. We didn't tell anyone. People have different sort of opinions on that, but we called him Little Norm for like a really, really long time. And even when we had the name decided and we were like, oh, it's going to be really hard to actually change the name. We need to start practicing this now. And so we would do it. And we didn't know his middle name. The middle name was very easy for us. Richard is Katie's dad's name, and Richard is my grandfather's name. And my grandfather's a stockbroker that, you know, a lot of people here know about. He was the one who helped me open up my own investment account when I was 15. Love, you know.
Pizza story.
Yep, exactly. So,
I added everyone's bio, so.
Yeah, there you go. Make sure you read that. The Domino story is very much a real story. But
good.
But, you know, Dick is short for Richard, and just don't love the short version. So we had to think of a first name and have that as a middle name. But yeah, you try it out, you see, because what you don't want to do is like they're here and then you're like, oh, that doesn't work. But we knew he was a Banks and felt right.
Also, not a fan of Norman whatsoever. So
neither was my mother-in-law.
I think Banks is way better name.
Thanks.
So everyone always talks about obviously how expensive having a kid is, and I think a lot of what I think there's two thoughts I think about it. I think about like college and how expensive the entire, you know, say 18 years of having that child is,
Wow.
which at least for me, I'm less worried about that because there's things you can do to mitigate that and to have accounts ready to go for college and for those later in life times.
Yeah. And what does college look like 18 years from now, mind you? Right.
That's,
right.
Yeah.
It could look completely different.
But it is like, okay, so going from you don't have a baby to now 9 months later you have a baby. Is life really that much more expensive than it was before that kid came in?
Yes.
What is the most expensive thing?
Well,
or what is it all encompass?
It's weird. There's sort of like these stages that you go through, right? So initially you're like, all right, you find out, you know, pregnant. You know, ideally, if you have health insurance, your doctor appointments aren't going to be that much because you have coverage through health insurance. But then you have to start preparing. So, like, first, you know, kind of part one really for us was, you know, we love where we live, but we live in an old house in Hermosa Beach, and we had to do some work on our house to like make our house a little bit more safe. Also, my office became the nursery.
Oh,
yeah, tough. So you guys have to see me in the office.
I was gonna say, is that why we've been seeing you more often around here?
Yeah, it's the office setup is, let me say, not as good as it used to, but Banks got priority on that one. But it's funny, like these are the things that you're like, you know, you don't just have your baby's room all ready, right? So it's like we get all my stuff out, we figure out what we're doing with the office, we kind of fix up what we need to fix up, and then it's like you get the room ready. And it's funny, is nursery is not a big room, but you know, you get the crib, you get the dresser, you get the lamp that fits just right, you get the really cool looking decal that you can only get from Australia.
Ooh.
It turns out, for that specific decal that we looked at for the course of 6 weeks.
Wow.
But yeah,
you got a woman with expensive taste. I got a feeling.
Let me tell you, it's not expensive. It's specific taste. It's specific taste, and like you want to try to do like the clean green and all that. And there's a lot of information out there, but it's like those are the things like right away. And you do the registry thing and all that for some people to help you out, but there's still the big ticket items.
Well, that's I think seems like why you start preparing early, right? Because if you didn't have all the tools in play for the last 10 years, then those things that would have had those things you would have had to start on now would take priority over maybe the fancy Australian decaled registry.
Well, let me tell you, like, thinking about it now, like trying to make decisions to do things, you don't even have time to think about it. Like one unexpected expense, I know that, you were asking me about this earlier. Like one unexpected expense is getting takeout food because like we like to cook, like we're not like an everyday cook, but like we're pretty consistent about like cooking, making meals and all of that. When you're helping your spouse feed the kid 10 times a day, do the laundry, do all these things, even if you have some help, but most of the time your help just shows up and just wants to hold the baby, which actually isn't helpful at all whatsoever. If you go see your friends that have kids, just walk in the door and just go clean up and let them hold the baby. That would be my unsolicited advice off the bat. But it's like the day just rips by. Mm-hmm. Like you have no idea. Like it just flies by. And the idea of like, okay, you finally have like cleaned up your house to a point that it's livable, to like the thought of like, all right, let me go get some groceries, cut up some veggies and like go make a real dinner is tough. And so like, and then this is like my biggest advice, and you're alluding to this, Chase, is it not just for the things of raising a kid, prepare beforehand, but like the finance component, there's a lot of things that you can do beforehand because once they're here, okay, it's really hard. In full disclosure, we still haven't gotten his birth certificate, and I was supposed to get that notarized today, and our notary isn't here because we're going to do a trip, and we have to get a passport. We have to get his birth certificate for a passport. And so it's like, that's so simple. Okay, it's a form. But yeah, like there's so many things you can do beforehand before they're here that make your life easy.
You don't just go home with the birth certificate?
I thought it was coming in the mail. That was part of it. You fill out all this stuff, but then I guess you need to like still fill out one more thing. Like I feel like that's so many things. Yeah. Like the hospital and all that stuff. They're like, all right, here you are 80% of the way there. And we know you haven't gotten any sleep. And this is a whole new thing that you have no freaking clue what you're doing. But like, you got to figure out the other 20%.
It's always funny to me you hear stories of parents who have their first child and they're at the hospital and they're like, okay, you can leave now. Like take the baby home. And the parents are like, no, we can stay. Like, it's fine. And like, no, just take it.
They intentionally, like, this is something I didn't know. That was not the case for us because we ended up being in the hospital a little longer before birth. So we had to get out. We had been there too long. But before you have a baby, the labor and delivery room, this nice big room, there's a couch, there's space. Like it's really nice. The postpartum room after you have a baby, and mind you, there's now 3 of you instead of 2 of you, is 1/3 of the size. And so I think that's part of the strategy is they're like, yeah, you just get out of here.
Did you have any thought of doing an alternative to a hospital, an at-home birth, tub birth, car birth?
I think the car birth is usually not planned. I saw in
a movie once though, they were driving and then she was having a baby and then he was going really fast and then slammed them. He's like, hold on to something, slammed the brakes and then it shot out.
I think that's exactly how that works. Someone at GK, I won't share who, almost had a car baby.
Really?
Someone almost had a car baby.
Okay.
Don't look at me and then because I don't want to lie to your face.
The advisor almost birthed the baby, or their spouse almost birthed the baby? Because that could eliminate a few candidates.
That's why I'm not even going to go into that, just to not make you think about it. But look, we thought about it. I think that a lot of people.
So you did think about a car baby.
The other types of birth, but I will say, your first kid, there are so many unknowns. Just the idea of like that many more unknowns is tough. And even talking to a friend who's a doula and all that, like her first baby was in a hospital, and then her like second and third were at home.
Okay.
I will say for us specifically, thank goodness we were in a hospital.
Yeah. I was a C-section baby, so.
Hey, me too, man.
Hey, let's go. You have a peanut allergy too, or
No, I'm all good.
Are you enjoying this episode of Chasing Finance and don't want the show to be canceled? Well, you can help. Just make sure to like, comment, and subscribe below. Well, all right. So let's think about this. I wanted to tell the story a little bit more. Before you found out, before you got married, before you even fell in love, you made a commitment to this child over 11 years ago when you started at GK.
True.
What was step one of preparing for banks?
The easiest one, really, the easiest one is the 529.
Okay.
Truthfully.
Yeah.
529, which I think in another episode, we're going to go into a little more detail on all of the accounts. But a 529, it is a college savings plan. But the tax benefit primarily is that the money grows tax-free.
Okay.
So your regular investment account that you have, your non-retirement, not talking anything like a Roth IRA or anything like that account, like you have dividends, they're subject to tax.
Yeah.
Like you make money.
Capital gains.
You make money and you sell some of your position. You got it. You got to pay some tax on that.
Sure.
And so with the 529, the money grows tax-free. Okay, if used for college education, and you can transfer that account. There's some nuances that we can talk about, but the money gets to grow tax-free, and so you're starting the timer early. Some states also offer a tax benefit, not California, but you start the timer early. Like same thing, I'm sure you've talked about a Roth IRA.
Yep.
Money's growing tax-free. The earlier you start it, the more beneficial it is. So that was that. I mean, that was the first thing. I put $100 a month away.
Easy.
And I told Katie when I met her, I was like, "Hey, honey, I got a 529," and that sealed the deal 3 weeks before the world shut down. So
nice. Was that pre-COVID? Did you guys like a COVID relationship?
BC,
or?
before COVID, yeah.
Wow.
Yeah, no, I remember all the dates in COVID very specifically because we literally went on like 3 dates.
Okay.
World shut down, and then I was like, "Hey, do you want to drive to Colorado and meet my whole family?" And
she said yes.
And she said yes.
Nice.
And I was there with my quarantina.
Wow, that's sick.
For the 529, so for 11 years, what amount did you, like, obviously that's 11 years without an actual child for this account to go to. How much money did you put in for those 11 years?
I just started with $100 a month. There's complicated rules, like if you didn't end up having a kid, because that's there's no guarantees there. Like you have some ability to transfer it to some family members, and I already had. Well, I guess my oldest nephew, I think is 8 or 9 years old. So like that was already kind of working its way there. And so I figured that could be something in the future, but didn't want to overdo it. Right. Because the risk of like, maybe you don't have a kid and all that. But then when Katie and I got engaged, that was when I got a lot more serious about like, okay, I found my partner. We've already had this conversation of planning that we want to have kids. And so started increasing our contributions. And then when we got pregnant, even more.
Okay.
Right. Because once they're here, that's when your costs really go up. Right. Once they're here, and like that's for the rest of their life. The first 5 years are more costs because you typically need, some people need more help at home because the kids aren't in school. For those first few years. But
does Katie work?
Katie works.
Okay.
Yeah. So she's still off. She's still off until April. We're going to figure out like exactly how that works. She works for a nonprofit, and her job has really good benefits as far as parental leave.
Okay.
Yep.
So I've heard about the 529. There's also this thing called the UTMA.
Yep.
And that means that basically, let's see if I can define it.
Let's see it. Let's hear it.
Cover up the laptop. I think basically it's similar to a 529, but you're putting the money toward your child that can use the money toward any expense when they turn 18. So it's basically a saving account for a child that has a lot less restrictions on it.
Correct. You got it.
So why would you want to choose the 529 over the UTMA?
So number one, if the account is an account for a minor, do you think you can open it before the minor's here?
No.
Good guess. Nice job, Chase. So yeah, number one, you can't start it early.
Okay.
You can't start beforehand. Number 2, the tax benefits aren't as good.
Aren't as good.
So the tax benefits when the account is smaller,
Mhm.
you know, the first 1,350, you know, I'm pretty sure that's the number as of this year. It's within range. Is tax free. The next of dividends or capital gains is tax free.
Okay.
Next 1,350 is subject to the child's tax rate. Okay.
Really?
I'm not gonna ask you if you want to know what child's tax rates are.
I was gonna say, wait, is that just what is it? Yeah, like the child's not
I
working.
think if you ask most
obviously.
advisors, they wouldn't know that. If a child has less than 12,000 in income, which is likely going to be the case,
Yeah.
unless they're, you know, my good friends. I don't ask the details. I don't know, but they just signed up their baby to be a model.
Nice.
And so I don't know what that income situations look like, but they're planning ahead. But under
That's
1150, the child's tax rate's 10% is what it is. So,
Okay.
and then after that, it's subject to kind of normal rules. Okay. The third reason, though, the primary reason that personally, if you ask me, sort of scares me on the UTMA account.
Ethics.
Yeah. What about ethics?
How do you trust the 18-year-old with all that money?
Correct. Right. And so different states have different rules. Like you can set it to 18, you can set it to 21. There's kind of a little bit of nuance there. So
Can you
definitely
change it too? Like, can you, like, if you put the money in a kid's name and then maybe, okay, you actually realize that your 18-year-old kid is kind of a loose cannon, you don't want to give him the money anymore.
You'd have to do it before 18, I'm pretty sure.
Okay.
Because you're still the guardian. But once they turn 18, technically it becomes their account. Yeah. And so that's hard for me, truthfully, because I know Banks is going to be the most responsible, diligent, good saver, wants to save for the future. So obviously he's fine. But
I mean, you started investing at 15, so
look, I am a person that would have been okay probably having a UTMA. I didn't, but having one of those.
Yeah.
But I'd be a little cautious. That part's pretty hard for me. And so like you get with the 529, that doesn't happen. With the 529, you maintain ownership of the account even when your kid turns 18. And so I really like that. You could also just set up an account, which I have some clients do this. They set up an account that is like for the benefit of the kid. Like they say, hey, this account number 234. Okay. This account is his account. Okay. But it's not set up in a way that it's like tax benefits for them.
Okay.
Yeah.
And the compound interest doesn't have to do with this. The way like a Roth or our other, this is just like regular, like you would just buy Google, watch it go up, take your gains.
Like, what do you mean not compound interest? Compound interest is in everything.
It's in that. Wait, no, I thought it was just in the Roth.
No, sir. Okay. So
normal investment accounts, you watch go up and down, you take your gains. They don't get reinvested.
Well, they do if you don't sell, right? If you continue to hold them, it's still compounding over time. So like you buy Google and Google doubles and you didn't sell a share, it's still growing on itself.
It's just,
what am I thinking of?
It's just like when you have $10, you know, a 1% gain on that $10 is a lot less than a 1% gain on $100. So as that account grows,
how much you make is more.
You're making a lot more.
That term is called confounding. Compounding.
Oh,
confounding.
No one's ever told me about that.
Confounding. Like,
let's talk about
it. So like, there's this really cool rule. We had not planned to talk about this at all. It's when I was like 22 years old, trying to get all my friends to start a Roth IRA. I'm so passionate about
I'm so into my Roth, by the way.
Yeah.
The last 4 months, I've put a quarter of my net income into my Roth.
That's great.
$1,000.
That's
a
great.
month.
There you go.
And I'm maxing this bitch out, and I still haven't gone into debt yet.
You can't do it for the whole year because you'd exceed the maximum.
No, I know, because I spent the whole first half of the year trying to make up for last year because of the fires. There's an extension. My amazing advisor, Mia Sampson, made me aware of that so I could keep. And then she's like, okay, you got 5 months. You've got till April to come up with another $6,000.
Yep.
And I just said, fuck it. No non-retirement. I want all retirement. I want all my money going to my Roth.
Yeah, I mean, you're giving up liquidity, but the money's growing tax-free. I think you're probably making the right call for you. But there's this cool rule. You will love this, Chase.
Confounding compounding?
It has to do with confounding compounding.
Let's go. Talk to me.
So has anyone ever told you about the rule of 72?
No. But you divide by 72, right?
Divide by 72.
No, you tell me.
So if you're getting a 9% rate of return on your money, you take 72, you divide it by 9. It takes roughly 8 years for your money to double.
Right.
Okay? If you got a 10% rate of return, it would take roughly 7.2 years for your money to double.
Okay.
Okay. So like, it's really fun to sort of think about, all right, let's like hammer your Roth IRA at a young age and just like let it do its thing. So for the Roth IRA, we can do 7,500 now, 2026 rules now. It's crazy. It's crazy how much it's moved. It was like 5,500 when I started.
Cool.
But let's say over the next 3 years, you get, just to make easy math, okay, you maxed out your Roth IRA every year. It would be a little bit more than this, but let's say you get 20,000 in your Roth IRA, okay?
Sick.
Okay, so think about this for you. And how old are you?
I'm 20. I just turned 25.
Okay, great. So let's say by the time you're 26, because you've already been putting some in, like you have 20,000 in there. Fair enough?
Which is, that's not unlikely.
Okay. So do you know what the long-term average rate of return of the stock market doesn't happen every year, but over long periods of time?
10%?
Yeah, it's 10, 11%. Okay.
Okay.
Do you know what inflation is?
Yeah. So inflation is like the devaluation of money.
Yep. So do you know what it's averaged?
3%.
Yeah, roughly 3%.
Told you, people don't believe I'm studying. Look, I'm learning things.
Hey, I'm testing you. This is
And
actually, you have the Series 65 coming up. This podcast is actually to test to make sure.
I've heard of rule of 72. I didn't know what it was, but it was in my brain somewhere.
Yeah, great.
Divide by 72. It's just, something like that.
So here's the thing. Stick with me here.
I'm here.
Stick with me.
I'm here.
So if, the average rate of return of the market is 10, 11%, inflation is call it 3. Okay. That means you're over a long period of time, okay, you would average 7% inflation adjusted return.
Oh yeah.
So although your average is 10%, you got to subtract inflation. Okay, this is rough numbers.
Sure.
Okay, so using the rule of 72. Okay,
72 divided by 7 should be like what?
72 divided by
Maybe
7.
Like 0.1.
72 divided by 7. What's 7 times 10?
70. So I was trying to get that 0.1.
It's just 10. It's 10.
Oh, 10.
Carry the 0.
Carry the 0. I was just
You're going
a couple decimals away.
You're putting the 0 in the wrong way.
Yeah.
So like roughly every 10 years, your money doubles in today's terms.
Wow, 10 years.
Okay, in today's terms, okay, it's every 7 and non-inflation adjusted. So like, let's say you get 20 grand in there. Okay, this is a retirement account. Can't touch it till you're 59 and a half. But let's say like this money, you're kind of thinking out of sight, out of mind for the next, we'll say 40 years. Okay, so that 20,000, assuming you don't contribute any more money into this account, okay, the confounding compounding component.
Because pretty soon I'm going to be making too much where I won't qualify.
That's true. Yep. So right now, let's just say you get 20,000, you stop contributing it, you let it grow for 40 years, okay, based on long-term average returns.
It's going to double every
banks.
10 years.
We're not talking about banks anymore, but
I know, I was thinking about that, but this is good.
So 20,000, okay, doubles
every 10 years.
And what does 20 turn into?
4 years from now. So that would be 80.
So 20? No.
So that'd be 100.
So, no.
Million, Sorry, go on.
20,000 double. Okay, first double. What does 20,000 turn
40.
into? Okay, then what?
80.
Then what?
160.
Then what?
320.
Okay.
So 320, it goes from 20 to 320 grand.
Without contributing any more money.
More.
And you let it go another 10 more years, that's 640,000.
And this is why I've been blowing up my Roth. Because pretty soon I'm not even going to be able to put money in there.
Correct. But this right here, like that's an example. So like think about even from like year 30 to 40 in this scenario. 160 turned into 320. That's just 10 years. In just 10 years. Versus the first 10 years, only 20 turned into 40.
Dang.
Right? So this is why and guess what? Just like a Roth, if this money's in a 529, it's growing tax-free. So it's accessible.
I thought it compounded differently in the Roth. What am I not getting?
You're owning the same thing. You just don't have to pay any taxes, right? So this is why the earlier you get money in the 529, the more tax advantageous it is because you don't need to put money in towards the end. And like before having a kid, like with a lot of my clients, I have this conversation. Not everyone wants to do this, but I'm like, hey, like start it now. Okay. Like it's a lot easier to save money right now. And then you stash this money away. It takes the pressure off on the back end. And we'll talk about next time. Like there's nuanced rules, like using for college, vocational education. You can now roll it into the Roth IRA, use it for private education. Yeah. Like you can do a whole episode just on Buy 29.
And don't forget, if you've got questions out there, drop them. Because we're going to be coming back answering more specifics, more numbers, more role play. I also wanted to talk about, I actually know somebody that has their Venmo linked to a 529. They don't have a kid. They have their Venmo linked to their 529 account, and they gamble on the golf course, and every time they win money, it goes straight to the 529.
It's funny. I feel like a financial advisor like wouldn't like that. I love that.
That's me.
I love that.
And that's Alex, by the way.
Yeah. So you know what? I love that. Like, it's any way you can trick your brain into doing something that's beneficial for yourself. It's like you're not putting in if you lose money. You're not pulling money
He tells his wife, I'm gambling for the kid.
But I also put $100 a month in.
Yeah, you gotta at least. You gotta at least put.
It's more a way to just be like, oh, this is a fun way to put a little extra money in every once in a while.
Yeah.
So, okay. And then
I think what you're thinking of with your whole Roth being different thing is just the fact that I don't think it's the compounding. It's that number you see in the account when you take it out, that is all your money versus having to pay the tax, and then you lose all this.
I thought every year. So if I have, doesn't the whole amount get reinvested every year though? Like I thought that was a thing.
Yeah, like if you let's say you have a $10,000 account, and you get $200 in dividends, you have to pay taxes on those dividends. So you lose $50. So instead of having $10,200, not including appreciation, you have a little bit less money. Versus in a Roth, you don't lose any of that to taxes. But
I thought that the full value of the account gets fully reinvested every year, though.
Same with your non-retirement. If you don't sell anything,
doesn't it get like reinvested though? Like I thought that it just kind of sits there, like regular. It just kind of sits there and goes up a little bit slowly. But I thought in my Roth, like the whole difference was that it takes the whole pile and then reinvests that chunk every year.
That's the same thing. It's the same thing. It's just that you lose some money to taxes. The only thing that is taxable is if you sell an investment for a gain, there's taxes due. And if you have dividends, then that's also due.
I clearly need to postpone my test, but, we'll get there.
Hey, that's why we're here.
Where you are now compared to the first episode of this podcast is wild. You've made some.
We're having fun.
Progress.
I kind of feel like his love language is words of affirmation.
You'd be surprised.
Chase's love language is just give him attention and look at him.
That's words of affirmation.
I'll just say it meant a lot that you brought back this podcast. I think you are my number one favorite person in the office now. So
I think you got to take Alex. It's got to be the first.
It's true. You'd be surprised. Alex is a little iffy. Should we keep the podcast? Should we not keep the podcast? Am I wasting his time? It goes back and forth by day.
All right, let's get back into the kids.
Okay, so you've got the 529, $100 a month for 10 years leading up to Banks. When did you start a UTMA? Do you have a UTMA? Is that not worth it? Is it worth it? What's your feeling on that personally?
So this sort of the short answer is we haven't determined how much we're going to put in the UTMA and how we're going to do that. And part of this actually relates into one of the most important things that you also need to think about as a parent, and I recommend doing the majority of this work before they're here, is minors cannot inherit assets. Okay. So if you have some accounts and your kid is set in Banks as the beneficiary and he's, something happens, God forbid, to both Katie and I.
It's going to go to probate.
Okay, good job, Chase. So it's going to go to probate, okay? Even if he is set as the beneficiary, okay, the state's going to get involved.
Wow.
Okay, because minor cannot inherit assets. And so what you need to do, and again, this is something that you should do beforehand because the brain power it takes to think about some of these decisions like while your kid is here, and even though my kid is a good sleeper, it's like it's super hard, but you can go and you can start the process of setting up a trust. And when you go through that process of setting up a trust, you can start to make some decisions on what if something happens to both of you. Okay, who do you want to be in charge? And you can separate this. Like, who do you want to be in charge of the assets for your kid? Okay, so eventually, Chase, you're going to keep saving your money and you're going to buy a house. Okay, I know it's really expensive in LA, but I'm
going to do it.
But you're going to do it.
Yeah.
You're going to get there, right?
I got people like you pushing me forward.
Absolutely. And so, you have your house, you have retirement accounts, you have, your brokerage account that you've invested, you now have these 529s. Like, you need to look at setting up a trust because your kid, when they're under 18, cannot inherit these assets. So,
right.
So, your spouse can get it. And if something happens to one of you, it's generally not too much of an issue as long as everything's
So does it just
correctly.
sit there in probate till they turn 18? Is there a way you write in your trust or will that, like, hey, it's going to go to my brother until Banks is 18? Or
So if you set up a trust, you avoid probate.
Okay.
If you set up a trust and if you do things right, you avoid probate. You should not have, ideally, you don't deal with probate at all. Okay. If you plan right, I mean, it's not you, you're dead, but your beneficiaries aren't dealing with probate. And like, let me just say, I've had to deal with this, with help clients through this. It's kind of a nightmare.
Yeah.
And it takes a really, really long time. And if you just do the work beforehand, you don't have to worry about it. But yeah, so for Banks, we're 95% of the way there. And there's just a couple things that we're buttoning up. Same thing. Like, when we started this, once we found out we were pregnant, Katie was pregnant. I was supporting her being pregnant.
Yeah.
But
you had
I'm a pregnancy
you're
ally.
part of that.
I
she didn't get pregnant alone. So
yeah. That's how that works. Thanks. But the trust has all these rules, and you ask, like, oh, like, when would Banks get the money and all that stuff? And what you can do is you can say, hey, they can get a certain amount of assets at these different ages.
Right.
And you can also say, like, this certain amount of money can be used for specific goals. So, like, if they want to start a business, they want to buy a house, like, sure, you can actually...
That's cool.
Yeah, you can effectively make some of these decisions that still kind of live on while you're not alive. So in some way, it's living on. And so you make those decisions, but also, like, who's going to take care, okay, of your kid if something happens? Like, who are you going to ask to be in charge? Okay, like, you probably don't want to set your parents because your parents are a lot older, right? And you might not remember to update your trust.
Sure.
And so, like, you got to make those decisions, and you can have that person be the different person. Also, just to add in, like, talking about the trust stuff, it's not the most exciting stuff to other people, but I actually find it very fascinating. But also, like, something could happen to you and you could still be alive. Okay. Like, you could need
disability. Something.
Yeah. And, like, maybe you're not able to make decisions for yourself. Right.
Oh, what is that called again? I've heard of that.
Yeah. So you can have certain healthcare directives. So if something happens to you, you can say, hey, if this is my state, like, these are the only things that I want to, like, help preserve my life or whatever it may be. But the one that you're thinking of is powers of attorney.
Powers of attorney.
Yeah. So, I've had, my grandparents have lived an amazing life, and some are here, some are not. But all of them required their kids to step in to help them take care of themselves, which included, medical, paying bills and all that stuff. And the parents don't have access to those. They don't have access to their bank accounts. They can't do anything unless there's a document that says that they can. And that's what the power of attorney is. And that's part of when you do a trust, you do that.
And how do you know if you trust them?
This is why you need to have the conversation before you have a kid and you're still getting good sleep.
Yeah.
Right. And what you can do is you can set multiple people to set up checks and balances. So you can have co-trustees.
Okay. Wow. What an interesting point from managing partner Ben Dunbar. Do you want us to continue to have awesome guests on this show? Then make sure to like, comment, and subscribe below. Thanks.
So that's kind of option one. Option two is, sort of what I talked about is having the separation a little bit. The problem with co-trustees is if you put in there that two people need to make every decision, then you're sort of forcing, like if one person's on it, one person's not, then it's like you're forcing that person who's maybe on it to have to consult with that other person for everything, which may just delay things. But I think one of the safest things that you can do, at least from a kid standpoint, is you can have one person who's in charge of the assets and one person who's in charge of taking care of your kid, and you have two different people.
Separated a little bit.
Correct. But yeah, look, you're having someone make decisions for your life, and
scary.
And look, Katie and I, we've that. It was not easy. Those decisions are not.
Did you put anyone through some sort of test, or did you kind of make a bracket? Or...
Yeah, it was basically a March Madness bracket, and we would secretly do this little all right, they did this, they're out. They did this, they're in. Yeah, exactly.
I mean, is there also could be a reverse power of attorney, because who do you really trust to pull the plug? If you give them all the money, then they're going to have incentive to cut you out.
Well, the healthcare directive, I will say, the power of attorney versus healthcare directive. Yeah, I'm not an estate planning attorney, so I can't go into total details, but your healthcare directives specifically say things. And so someone who even had, yes, they have, they can have power of attorney for healthcare decisions, but the quote unquote pulling the plug, if you have specific items spelled out in your healthcare directive, that's what the doctor should look at.
Good.
Yeah. So not going to have banks make the decision of having to pull the plug or not, I guess.
I mean,
really uplifting stuff here. Yeah.
It is interesting.
It's exciting.
Oh, it's fascinating. Wait till you hear about taxes when you die, but that's not today.
It's almost like I was thinking when you were talking about all this, it's almost like reverse gambling. You're like, if the worst thing happens, you have
That's
something.
what's depressing about this job. You're always planning for the worst.
Yeah, hope for the best, plan for the worst. But it gives you so much security when not even the best happens, but middle of the road happens, but you plan for the worst, because then you're in a super strong position. And I mean, that I can go on so many rants on this, but I think when you talk about, this is good advice for both of you who don't have kids right now, is everyone in their mind has this, not everybody, a lot of people have in their mind, okay, when I make a little more money, I'll be able to save a little more. And when things get a little bit better, then I'll be able to do it. And they sort of deflect, defer. And what happens is inflation is still happening. So things are getting more expensive typically. Your circle of friends is maybe doing more fun things, because more fun, more expensive.
That's the worst part.
Not always correlated, but sometimes negatively correlated, fun and expensive. But so then your expenses are going up, and then you're working hard, and you're like, well, I deserve this. And so what you need to always do is start stacking money away, even if it's a little bit amount, automatically, so you never see it. Personally, for me, I direct deposit money into my investment account. So that money never even has a chance to make it to my bank account. And despite what you may think, when the money's in my bank account, it does burn a hole. I'm like, all right, I feel more comfortable doing something.
Yeah.
If it's in my investment account, I can only use that for investments. Okay. Obviously, if it's in the 529, I can't, be like, all right, Katie, we want to go on this vacation. We got to take from the 529, and to be penalized, no chance, right?
Yeah, and it hurts. It hurts. But these are the, same decisions my advisor made for me that I fought and fought and fought.
And fought.
And still fight sometimes. But it's true. I mean, when you look at the net worth, and it's what, like you said earlier about just planning for the future, the security of knowing, it's at first it was so hard not knowing I can touch the money till I'm 60, right? But then I'm I can always make a buck, right? Let's say worst comes to worst, I'm, making just enough to live from age 50 to 60, knowing that I could, have enough to retire when I turn 60 is that peace of mind is incredible.
Yeah, but and think, we talked about earlier, when you start early, you take the pressure off on the back end, right? Your 160 turned into 320 between the ages of 55 and 65, right? Which only costs you initially 20 grand.
What happens if the market crashes right as you're about to take out You're about to turn 60. Can you leave it in there till it bounces back till you're 70?
I mean, if you have money and you're still working, so you don't have to take it out when you're 60,
Okay.
right? You have a Roth IRA, you never have to take money out as of now. Pre-tax accounts, you got to start taking out when you're 73. These rules are somewhat changing a little bit.
Sure.
But it's important that you're proactive once you start taking money out of your account or are planning to take money out of your account, you're a little... Your strategy can't always be just own 100% stocks because, if you have, let's just say $100,000 and you take out $10,000 and then the market goes down 50% or 40%, that's a huge, huge move. But because you took money out and it went down, your rate of return to get back to even is going to be like 100%. Like if 100,000 goes to 90,000, and let's say 90,000 goes to 50,000, which is a 36% decline. Okay, to get back to go from 50,000 to 100,000, what's your rate of return that you need?
100%.
100%. You said double, right? And so a lot of people sort of make the mistake of like, okay, I'm going to retire, then I'm going to start making these decisions of like what to do, how to change my money. It's like, no, like you got to get more conservative as you're approaching, and like, when you're talking about saving for a down payment, you don't want to lose your whole down payment the day you go buy a house. So you got to just work with someone.
Were you buying bonds at 25?
At 25? Not really.
No.
Yeah, no. I mean, never bonds and retirement accounts ever. But I mean, maybe some, because as I bought, oh my God, how old am I? 33. So I did buy my house at like 27. 20, yeah, maybe I had
27? Dude, I gotta shape up, bro.
I think so. I mean, interest rates were lower, a little luckier. Housing is less.
This is a good way to get into.
Crazy, bro.
I know this is not about housing, but I see my whole like feed on social media, just obviously like everyone, feeds me what frustrates me.
Yeah.
And something that
Detroit Lions blew it this year.
Something I come across a lot.
That's a coordinator.
Oh, let me forget.
Is people saying that like, okay, say like basically they're talking somehow like describing me in someone else, right? That I really relate to. And they're like, if I were you, they always give the advice. It's just, unless something crazy changes, like you probably shouldn't buy a house. Like there's no reason why, if your goal is wealth creation, you should not be buying a house unless interest rates go down a ton or, something else happens.
Yeah. I mean, we could have a whole episode. I love housing is super interesting, but I don't love the Instagram videos that say everyone is the same. But if a lot of times, because of like those numbers that we just talked about, like for the Roth IRA, right? You put that money like towards a house, right? You now don't have that money compounding over time. People are insanely successful with wealth creation for real estate because they don't feel the need to do anything when things change. Okay. When when the market, when the market goes down, they're not like, oh crap, the real estate market's down. Let me go rush to sell my house right now.
And they're forced to still pay their mortgage.
Exactly. It's a forced savings. And so they're building equity no matter what. They don't change strategy at all versus, so many people, when the market goes down, they're like, oh, I didn't realize I was comfortable losing money. I can just hit a button. Yeah. Okay, I can just hit a button and sell some, not all, but just even sell some.
Yep.
And can like pause my contributions.
And say it with me. Only cowards sell / pause contributions.
Yeah, that's not, people make mistakes, but this is what you have advisors to support. So you got to be a little nicer to clients sometimes.
Yeah.
It's just seeming more and more like,
but
it's not like, why do you want to just rent?
Well, I mean, look, talk about having a kid when things change, like a sense of security has a lot of value, right? And so, you got to look at what works for yourself and not always be like, what is the most maximum financial decision? But yeah, the cost of housing for purchase relative to income, okay, over the past year is the worst it's ever been. Okay. cost of housing relative to income, okay, especially when you own, worst it's ever been. When we live in, where we live, it's to the extreme also. So like the math, like when you go look at the total cost of ownership of renting versus owning, and you can then don't need to take money out for a down payment to go buy a house, like oftentimes the math says to rent. That's oftentimes what it says. With real estate, what you do get a little more of is if you're in an area where housing is appreciating a lot, you get what's called leverage. You buy $1 million house, you put $200,000 down. If it goes up 5%, okay, it's appreciated 50 grand, but you only put 200,000 in. You had to make payments over time, but you made 50,000 on 200,000. That's 25% rate of return.
I often forget about that part.
Yeah, but over the past year, real estate is down, right? People actually don't realize this. Okay, I don't know the exact percentage, but I think nationwide real estate is down in the range of like 5% over the past 12 months.
Dang.
Now there's limited inventory. There's, a lot of things have changed, but it goes the other way, right? So you buy $1 million house, it goes down 5%. Your 200,000 turned into 150. Right. So, and it only went down 5%, but you lost 25%, right? You got to get out. You got to pay transaction costs when you sell, right? And there's like a lot of negatives. But when you hear the really successful real estate stories, it's when people bought their houses 40 years ago and they never did anything. But the joke of it all, okay, the rate of return that you see is usually like in the 5s, okay? And my grandma is still around. My grandpa, the stockbroker's not here anymore, but they have owned the same house for 70 years. Okay.
Dang.
70 years, okay? They bought it for like $25,000, okay? And I don't know exactly what it's worth, but maybe in the range of like $2 million.
Yeah.
Okay. And that rate of return is like 5.5%. If they put that money in the market, if they put that 25 grand in the Dow, because the S&P wasn't around then, that 25 grand would be like 10 million.
Well, at the same time, were they also investing though?
Yeah.
I think that's the thing I always think about. Is like, it seems like now you have to make the decision versus in the past, you could do the house, but you could also have enough money left over to then invest.
Yeah. Why do you have to make the decision now?
Because the cost is so high.
Because if I was to buy a house right now, like I would have to like stop going on any vacation. I'd probably have to sell my car and get a really cheap car. Yeah. We'd have to like really focus on our grocery costs, which I'm willing to do, but I can't, even with all that, I can't do it.
But with that, but like, this is where like, you gotta weigh everything, right? Not just like, not everything is financial, but like all that type of stuff, like sacrificing every single one of those things just to say you own a house, like hearing you say that, I don't think it makes sense.
Well, those are interesting because those are things that I think my parents often will be like, because they don't necessarily agree with this whole thing that's the truth of it's hard to buy a house now compared to when they did it.
Correct, yeah.
And
just tell them to loan you
they're
money
like,
and then you'll buy a house.
Well, I've tried that and it doesn't really go well. But they'll be like, oh, well, we didn't drive, a Tesla when I was your age and we didn't do this. And I was like, believe me, if the difference between us owning a house and not was me selling my Tesla, I would have sold it, years ago.
Yeah, everyone is playing their own game. And like that would be, there's so many lines that my poor family, wife, friends, clients have to hear me say all the time. But that's one of the big ones is everyone's playing their own game, right? And so you may see someone own a house and you're like, how did they buy that $2 million house or whatever it is? And you don't know that parents helped them, right? You don't know that parents.
Or you do know.
Well, you do know sometimes, but people are proud and people don't like to share when they got help. And so it's just like, you got to look at what works for you. And our place right now is not set up once banks can walk, in all honesty. And like, we got a great deal. We love where we live. We live in an amazing neighborhood, but like our house is not set up, for our place to be a year from now. And we're going to have to make a big decision of what's next.
Ooh.
And it's very hard because we know where we want to live. And it has gotten, even since when I bought, so much more expensive from a total cost standpoint. And like, I think there's a decent chance that our next place is rent because like you, Alex, like I don't have this like even for me, I don't have, even though I lived in the same house my whole life, like I'm the pride thing. I'm like, if renting makes sense for us, then I'm good with it. Right. And like, that's kind of a wild thing that like, we may keep it, we may sell it, we may decide to rent, but everyone's playing a different game. And
something that often calms my thoughts about all this is when, for the longest time when I started working here, Roth was renting his house. And no, I don't have like a pride thing about owning versus renting. It's more having the space and more so, I love like little projects and improving the house and having being able to do the things that you want to do to it because you own it versus having to like ask someone or not be able to do it. But
or just do it and just see.
Well, like that, like, see, like that to me, that to me is and look, being a stock guy, I mean, comfortable with that. Like that to me right there, like that's where you have opportunities to add value. Right. And like that isn't on the spreadsheet, right? That's not on the spreadsheet. It's if you can do these little things that make your house look a little bit nicer, that, you know, eventually could increase the value, that makes it attractive to someone. And, you know, you bought $1 million house, you put $200,000 down, you sell it for 1.5, you know, down the line, assuming it appreciated, right? You now have 700,000 for your next place, or, you know, 600,000 after transaction costs. But, and then also that brings you joy. Okay. So like, you got to weigh that. Right. Yeah. And so like, that's where I hesitantly say like to give this like generic advice that I think people give all the time. It's just like everyone's version is different. Like what people spend money on is different. What's important to them is different. But like I'd say, I know we've kind of gone on tangents, but
we can come back to this, do a whole episode on.
It's fun. Keep talking.
Yeah, no, I mean, we can talk. I mean, like, that's what's nice is like you can iron things and like this is what it's about. But the biggest thing is like you just can't wait to put some money away. Right? Like I feel like I say all these things of like it's a balance, like you got to choose what you want, right? But you got to kind of set minimum thresholds to not set yourself up for failure, right? Because if you don't save money for 5 years before you have kids, right, you're probably not going to save money unless you get really lucky with a better job or whatever. Like you're not going to all of a sudden be able to save money when you buy a house and when you have kids, right? Let alone if they need to go to private school where you live. And like, that's a big decision that people need to make. You know, for us where we live, that's a big reason why we live where we live is like, I went to public school, great public schools where we live. And, you know, you have to spend that money with after tax dollars. School's so expensive.
Yeah.
I think that when I first shot, can I afford a kid? There was no, even thought that I was going to start saving, but hearing you talk, I'm thinking maybe $100 a month in a 529 wouldn't be the worst idea for me.
Yeah. You got to have some liquidity.
Yeah.
Okay. You got to have some liquidity. So like you're doing the Roth IRA, that's better. That to me is better than the 529. So you're doing that, right? You have the opportunity to do a Roth 401k, a pre-tax 401k.
Yeah, I'm doing that.
So like your retirement account's probably a little bit of a higher priority, but and then you have to have some liquidity. But like adding on,
I'm fine. I'll take it back then.
No worries. Adding a little bit, I think, is a great idea. And then also like you learn to live without it. Yeah. Right? Think of every subscription that you pay for. Right? You're just like, all right, whatever it is now, like that's what I'm paying for. And you know, if you're like me and been really milking the parents' subscriptions for a long time and finally getting kicked off, it's like I look at these and I'm like, yeah, you know, it's not worth it.
I was going to ask you about the 529 earlier. So I have one, but we want multiple kids. Do you, based on the presentation you gave on Monday, was the first time I thought, oh, I probably should open a second one. Is that, and mainly because of the same person has to have it for 15 years if they want it to roll over to a Roth?
I think it's so nuanced, and I think we should just have a whole episode on just that. Because
Dang.
because the short answer,
I told you he asked the best questions.
it's complicated. And, there's these new Trump accounts that we didn't even talk about.
I know, that was my next thing.
Yeah. And I think that's something that we can tackle.
Finance is so interesting. I think we should leave it here.
Yeah.
Mhm.
There's other stuff. I just did a deep dive also from your presentation. I was learning about employer sponsored life insurance plans.
Yep.
And because Hannah just got a new job, so we're looking into. I was reading her whole thing,
Yeah.
Yeah.
and I learned all about that. Which I was like, have I been here for 5.5 years and I've never even known about what that means and why it's different from the other ones.
Yeah, I know, especially as a doctor.
Yeah.
There's a lot of opportunities that you can get through that. And your the employer sponsored plans, which, another one we can go through, but the employer sponsored plans are great as a bonus oftentimes. But for some people who if Hannah's going to be a doctor for the rest of her, career, it's hard to imagine that she's not going to be a doctor.
Mm-hmm.
Right. And so in that scenario, she will probably always have some form of a life insurance plan, right? Versus someone else who maybe is more as an entrepreneur, wants to start their own business or take time off to be a parent. There would be periods of time where they wouldn't have coverage. Right. And so that's where you need to have a supplemental policy. And we didn't even get into it, but you better have some freaking term life insurance before your kid gets here, because your family's depending on you and you don't want something to happen to you.
Yeah.
I'll run this by you real quick and then we can stop it.
We'll
But
get to the outro for
we
sure.
can go to the outro. But because the way I was thinking about it, Hannah has a term policy that we got that's pretty cheap for $1.5 million. And obviously the thought is to add to that at some point. So you could either up that and pay more monthly on that premium.
Mm-hmm.
Or then when I was looking at the employer sponsored ones, which I didn't realize that they're really cheap when you're young and then they get really expensive when you get older.
Yeah.
Okay, maybe we just beef up her life insurance by doing that plan for the first 20 years of our kid's life, and then we can drop that and go back just to the 1.5.
Yeah. The risk you run with that is your health can change. Things can happen. Right. So you're paying when you get life insurance early, you're locking in your health rating. Right?
But isn't that how that one works too?
It does, but it spreads it out over time. So what'll end up happening sometimes is this is an example of a client that's in my head right now. I have a client, he's late 40s, has young kids. We went to get him life insurance because it was a new client. He didn't have it yet. And stuff came up, basically. And so the cost of his insurance for term would have been $200. I can't remember exactly, but it would have been $250 a month. And instead it's $800 a month.
Whoa.
Yeah, huge difference. And it's just kind of some weird thing. He's fine, he's healthy, but insurance companies are weird with certain things. And so then for him, we had to go with the group coverage. And the group coverage is $450. So it's more expensive than the term because he's a little bit older. I mean, he's older.
Do they do a medical check on you for the
typically not for the group.
Right,
Typically
okay.
not for the group. But and so that's kind of the trade-off there. And oftentimes you're limited on what you can get for your group coverage.
Mm-hmm.
Okay. It's so weird, your perspective of how much coverage you're going to need.
Mm-hmm.
And what I like to think about as a strategy is you have both, and you can have multiple policies. Because if you have multiple policies, it doesn't necessarily increase the cost. If you had two $1 million 30-year versus a $2 million 30-year, it can be slightly different. But you can ladder them with different time periods when you maybe don't need as much coverage.
Mm-hmm.
So right now, Katie and I have a big mortgage. We have one kid. We want to have more kids. Okay. Our insurance need is very high. Very high. And assuming what our plans are is it's very high. In 10 years, we will have paid off, more of our, we'll have more equity in our house, right? I know we talked about maybe renting, but we'd have more equity. And also we've just saved more money and put more money away. So we have more assets in case something happens. So in 10 years, maybe we wouldn't need as much coverage. And then in 20 years, way less because there's not as much cost required to like raise little ones. So, but that's, that's something we can talk about. But yeah.
Yeah, I think it's so interesting.
Well, we're just scratching the surface, it seems like. Well, thank you for joining us, Mr. Dunbar. Thank you to everyone that's out there listening, watching. I'll be honest, we came in here today. I didn't know that this was going to be an episode of Chasing Finance. Had I known, would I have worn a suit to sit down with managing partner, big dog at the firm? Yeah, probably. Would I have done my hair a little bit better? Yeah, maybe. Would I have had better questions? I don't know. Probably not. But we came here ready to start our own little mini series. But I want everyone out there to know that Mr. Dunbar is a true supporter of bringing back Chasing Finance. Okay? We're still on thin ice here. But guess what? What Ben wants, Ben gets. So this episode will see the light of day. You must support. You must drop your comment. You must drop your question, your likes, show the love for this, because we want to keep sitting down, having these conversations, and growing more financial wisdom and spreading it around. I do want to say that there's a lot more to be said. There's a lot that I did write down that we didn't cover. I've got 1 year. I just had my 25th birthday to figure out what the hell I do for my own insurance. HSA, FSA. Shit, I might even need some disability insurance. All this ADHD running around. So if you have questions about what else? Oh, another thing I wanted to talk about, the Trump accounts. These new Trump accounts for family planning are a huge deal. We want to go deeper into life insurance. Whatever questions you have, let's just say now, are we going to do a part 2?
100%.
100% we're doing a part 2. So if you're out there, you have those questions, you have those in-depth
All right, Ben's got to go. I think he has a meeting.
ponderings. We'll be back.
I have to meet with my client.
Drop it in the chat.
Yeah.
We're meeting with people with kids. Thank you so much, Mr. Dunbar, for being here. Thank you, Alex. We'll see you guys soon. Roll the music.
Nothing but trouble on my mind. That's the attitude that got my ass off the sidelines. You either ride.
Please remember that nothing you say here should be taken as personal advice. This conversation is for entertainment purposes only. If you have questions about your financial situation, please talk to a licensed financial advisor.